Welcome back to the week that was.
Great to be here.
If you felt like the ground was shifting under your feet this past week, well, you weren't alone.
Not at all.
We've had a sheer intensity of events. It felt less like a standard trading week and more like a collision of 3 or 4 different movies playing at once.
That's a great way to put it. You had this, political thriller with the Fed.
A Wall Street drama with the ETFs.
And then, a sci-fi horror flick with miners and AI in the background. It was really a cinematic week, wasn't it?
Absolutely. It's been a week where Bitcoin acted less like a currency and more like a barometer for global chaos. We started with fear over the Federal Reserve, moved into this, euphoric ETF buying frenzy that pushed us near $98,000, and then...
And then reality checked back in.
It did.
It did. And that reality check is what we really need to unpack.
Yeah.
Because the price action, it tells one story, that we're consolidating, but the plumbing of the market.
The plumbing tells a very different story.
A very different one. We're seeing a separation between what I've been calling the adult table of corporate adoption.
Right.
And the casino of hacks and, the political infighting.
I love that distinction. So our mission today is to separate that signal from the noise. Let's start at the very top with that macro-political collision.
Okay.
We had an explosive start to the week involving the Department of Justice and Fed Chair Jerome Powell. Let's unpack this. What actually happened?
This was the moment the market just held its breath. The DOJ issued subpoenas.
To the Federal Reserve.
To the Fed, yeah, regarding renovations to their headquarters. Now, on the surface, that sounds like a really boring bureaucratic issue, right? Cost overruns, contractors.
But you have to look closer.
You have to. Powell's response was immediate and defiant. He called it a pretext.
A pretext for what?
To force interest rate cuts.
Wow.
The implication here is massive. I mean, the market interpreted this as the administration potentially using legal pressure to strong-arm the Fed into cutting rates to 1% or even lower.
A constitutional crisis of money.
That's what we call it. Because the whole point of the Federal Reserve is its independence from the White House, so politicians can't just print money whenever they want.
Right, in an election or something.
Right. If the Fed is just seen as an arm of the executive branch, the dollar acts very differently.
It loses that credibility.
It loses that veneer of impartial management. So naturally, the market panicked a bit.
And usually when the dollar looks shaky or political independence is threatened, Bitcoin goes to the moon.
It should.
But we saw a really interesting price reaction here. It was a round trip, wasn't it?
It was a classic whipsaw. We started the week consolidating around $90,800.
Okay.
Then we got some soft inflation data. CPI came in at 2.6%. And that, combined with this Fed chaos, it triggered a rally.
And we broke through resistance.
We broke resistance at 94,500 and surged up near 97,800.
But we didn't stay there. And that's what I really want to get into, the failure to launch.
No, we didn't. And that's the aha moment of the week. By the end of the reporting period, we cooled right back down to that $94,000, $95,000 range.
Okay, but here's where it gets fascinating.
The decoupling.
The decoupling. By the end of the week, the NASDAQ was rallying on semiconductor news. Tech stocks were up.
And Bitcoin was slumping.
So it stopped following the tech stocks. Usually they move in tandem.
Exactly. It decoupled. And that suggests the selling pressure on Bitcoin wasn't about the macro economy.
Right.
It wasn't about inflation or the Fed anymore. It was internal. Something inside the crypto market structure was forcing the price down, even while Wall Street was, partying.
Okay, so let's dig into that internal pressure, because for a minute there, it really looked like the institutions were buying everything in sight, this wall of money.
The numbers were just staggering. In just 3 days midweek, the U.S. spot Bitcoin ETFs saw $1.7 billion in net inflows.
$1.7 billion.
Yeah. And to put that in perspective, that demand was outstripping the new supply from miners by a factor of 13.
13 times the supply? I mean, that sounds like a recipe for a vertical line on the chart. If demand is 13x supply, the price has to go up.
It should have been a God candle, as they say. But then came the reversal. We're calling it the Fidelity flush.
The Fidelity flush.
Just as we were pushing those highs, the sentiment just flipped. We went from record inflows to nearly $395 million in outflows in a single day.
Wow.
And Fidelity alone saw over $200 million leave their fund.
So the big allocators, they looked at 97,000 and said, thank you, I'll take my chips off the table.
Precisely. It signals that for the institutional crowd, the people buying these ETFs, this is still a trade. It's not a religion.
They are not diamond handing this.
No, they are happy to sell into liquidity.
Yeah.
But while the ETFs were fickle, the corporate treasuries were doing something much more structural.
Right, the adult table. We saw MicroStrategy do what MicroStrategy does.
Yep. They bought another 13,600 Bitcoin for $1.25 billion, basically defending that $90,000 floor.
But I was more interested in this Strive and Semler deal. This feels new.
This is a major evolution. So Strive Inc. acquired Semler Scientific, but you have to look at why.
Okay.
Semler had a massive Bitcoin treasury. This wasn't a healthcare merger. This was an acquisition of a balance sheet.
It's M&A for Bitcoin.
It is. They consolidated their treasuries and created a massive corporate holder. They actually surpassed Tesla in holdings now.
That is wild. Companies buying other companies just to get their Bitcoin stack.
Yeah.
It's like how tech companies buy startups just for the engineers, but here it's for the digital gold. And it wasn't just in the U.S., right? We saw the floodgates open in Asia.
This might be the most underreported story of the week. South Korea lifted a 9-year ban.
A 9-year ban.
And they are now allowing corporations to invest up to 5% of their equity in crypto.
And that's the Chimol bid we're hearing about.
Exactly. The Chaebol, these massive family-run conglomerates in Korea, Samsung, LG, Hyundai.
These aren't just companies. They're a huge chunk of the Korean GDP.
A huge chunk. So imagine if they start allocating 5% of their treasuries. We are talking about a structural wall of money that's way stickier than the ETF traders.
It could position South Korea to become a MicroStrategy nation.
Potentially, yeah.
So, okay, we have this massive buying pressure from Korea, from MicroStrategy, from Strive, and yet the price struggled to hold 97,000. Why? Who is selling?
This brings us to, I think, the most significant shift in the ecosystem right now. The miners.
The miners.
For years, the narrative was that miners are hodlers. They mine it, they keep it. That is changing. Miners are pivoting.
Pivoting to what?
Artificial intelligence.
Right.
Look at Riot Platforms. This week, they liquidated about 1,080 Bitcoin. That's roughly $96 million.
And they didn't sell it because they were broke?
Not at all. They sold it to buy land in Texas to build a data center for AMD.
For AMD, so they're swapping Bitcoin for high-performance computing chips.
Effectively, yes. They are pivoting their entire business model. Instead of solving cryptographic puzzles for Bitcoin rewards, they want to host the compute power for AI models.
And what was the market reaction?
Riot stock jumped 16%.
Wait, they sold Bitcoin and their stock went up?
Yes, because Wall Street looked at that trade and said, we value steady AI revenue from a contract with AMD much higher than we value the volatile economics of mining Bitcoin.
Mining is unpredictable.
Very. And AI infrastructure contracts are steady cash flow.
That is fascinating. It's like they are cannibalizing their Bitcoin business to feed the AI beast.
It's a survival strategy. And we saw Hut 8 do this with Anthropic recently, and their stock is up massively over the last 6 months.
So what's the consequence for us, for investors watching the chart?
The consequence is that miners are becoming structural sellers. They're selling the asset to fund their transition into being AI infrastructure companies. And that is a heavy, heavy lid on the price.
So we have the institutional put buying, but we have miner capitulation, selling to fund AI. That really explains the gridlock in price.
It does.
But speaking of gridlock, we have to talk about Washington. We mentioned the Fed, but there was actual legislation on the table this week, the Clarity Act.
And it didn't go well.
No, it collapsed. And frankly, the industry breathed a sigh of relief. The digital asset market structure bill stalled after Coinbase pulled its support.
Coinbase pulled support? I thought they were begging for regulatory clarity.
They want clarity, but not at any cost, you know? The issue was that the bill attempted to ban interest on stablecoins.
Which is a huge win for banks.
A huge win for banks who don't want the competition. I mean, think about it. If you can get 5% on a stablecoin, why would you keep your money in a savings account earning 0.1%?
You wouldn't. The banks know this.
So they lobbied to ban the yield. And the bill also tried to increase surveillance on DeFi.
So the industry decided no bill is better than a bad bill. Essentially, yes. If you pass legislation that kills the utility of the tech, you've lost. So they walked away.
So we're back to square one on that front.
In a way. But the political warfare is escalating. We saw Maxine Waters accuse SEC Chair Paul Atkins of pay-to-play politics. It's getting messy.
But there was one silver lining in all that mudslinging.
There was. The White House and the Samurai Wallet funds.
Right.
The White House confirmed that the Bitcoin forfeited in that case.
That was the privacy mixer case?
Right. That Bitcoin would not be sold. It's being kept in the strategic Bitcoin reserve.
That is huge. Usually the government seizes it and auctions it off, crashing the price.
And now they are hodling. It confirms that at the executive level, the U.S. government has moved from a net seller to a long-term holder. That removes a big supply overhang.
Okay, here's where it gets really interesting, or maybe terrifying, depending on how you look at it. We saw a major institutional strategist dump Bitcoin this week. Not because of price or regulation, but because of science fiction.
It sounds like sci-fi, but for some, it's becoming science fact. Jefferies global strategist Christopher Wood. He removed Bitcoin from his portfolio and reallocated to gold.
And his reason?
Quantum fear.
He thinks quantum computers are going to hack Bitcoin.
Essentially, yeah. The fear is that quantum computers will advance fast enough to break Bitcoin's encryption, specifically the ECDSA algorithm.
The lock on your digital wallet.
Exactly, the lock. If you can break that math, you can derive private keys from public keys. You can steal the Bitcoin.
That would be game over. If the lock is broken, the vault is wide open.
It would be. And while most technologists think we're still maybe a decade away from that kind of power, the fact that a mainstream strategist is financializing this fear, that's significant.
It reframes Bitcoin from digital gold to what?
To a tech stock that risks obsolescence. He's basically betting that the tech will break.
But the industry is fighting back, right? I mean, the developers aren't just sitting there waiting to get hacked.
No, they're active. Just this week, BTQ Technologies launched a quantum-safe Bitcoin testnet.
Okay.
They're proving that the network can upgrade, that we can soft fork to new quantum-resistant algorithms. So while the threat is theoretical, the defense is becoming engineering reality.
An arms race. But speaking of security risks that are not theoretical, let's talk about the casino.
The Wild West was still wild.
It really was. We saw some brutal infrastructure issues. We always talk about Bitcoin's uptime.
Right. Compare that to the Sui network. It suffered a 6-hour outage this week from a scheduling bug.
A 6-hour outage.
$1 billion in assets were frozen. You couldn't move them.
Wow.
It just reinforces the reliability premium of Bitcoin. Bitcoin might be slower, but it doesn't turn off.
And then there was the hack. A massive one.
$282 million lost in a social engineering attack. A whale lost a fortune.
Unbelievable.
And watching the flow of funds was really instructive. The attacker didn't go to a mixer. They aggressively swapped the stolen funds into Monero.
The privacy coin.
Right. And it pushed Monero to an all-time high. It shows that despite all this talk of regulated ETFs and clean crypto, there is still massive demand for private censorship-resistant value transfer.
Which brings us to the flip side of censorship resistance, Tether.
Yes. Tether froze $182 million on the Tron network.
At whose request?
At the direct request of the DOJ and the FBI.
So much for uncensorable.
Exactly. It just destroys the myth. Tether is not digital cash. It's a database entry that can be edited by the United States government. If you hold Tether, you're holding a permissioned asset.
And we even saw ransomware evolving, using Polygon smart contracts.
This is a nightmare for regulators. The ransomware uses the blockchain for command and control. Because the smart contract is immutable, it can't be changed or deleted.
The authorities can't take it down.
It's permanent. And this will likely fuel those calls for the Clarity Act and more DeFi surveillance we were talking about earlier. It gives the regulators ammunition.
So what does this all mean? We've got this incredible split screen. On one side, BlackRock and MicroStrategy buying billions. On the other, miners pivoting to AI and strategists fleeing quantum computers.
It's a week that was just defined by bifurcation. You have the institutional put fighting against miner capitulation, the easy money phase of the breakout. It appears over. We are now in a high friction zone.
It feels like the market is trying to figure out what Bitcoin actually is. Is it the future of money? Or is it just a funding mechanism for AI data centers?
That is the critical question. Investors are starting to selectively pick winners. They're looking at infrastructure like the miners, pivoting to AI as a potentially safer bet than just holding the asset itself in this volatile range.
They're buying the shovel sellers, not the gold.
Exactly.
So for you listening, the takeaway is, don't just watch the price, watch the plumbing, watch the flows.
Absolutely. The institutional put provides a floor, probably around that $90,000 mark where MicroStrategy is buying. But the upside is capped by this structural selling from miners and that Fidelity flush. We're in a battle of flows.
A battle of flows and a battle of narratives.
Yeah.
From quantum fears to constitutional crises, it is never boring.
Never. And I'll leave you with this final thought.
Okay.
We saw miners selling Bitcoin to build AI data centers. We saw strategists selling Bitcoin over fears of quantum computing. Are we seeing the beginning of a transition where Bitcoin is no longer viewed as a currency, but as a legacy technology stock that risks being superseded by the next wave of tech?
Wow.
If AI and quantum are the new frontier, does Bitcoin become the old tech of the future?
Is Bitcoin the AOL of the 2030s? That is a heavy thought to end on. We'll have to wait and see. That's it for the week that was. Thanks for listening, and we'll catch you in the next deep dive.